is there a broad theme which the pandemic has thrown up, which is particular and peculiar to Japanese financial institutions?
Good day to you. As far as the Japanese banks are concerned, COVID-19 has two impacts. One direct, which has been on the market value of their very large equity holdings. And secondly, the indirect impact is the impact on their customers. That has yet to be seen how bad that is going to be. Certainly, I don't think anyone is expecting a V-shaped recovery, even in Japan, as Japan emerges from its lockdown. But for the banks, that suggests that we're going to see much closer to the 25-30 basis point credit costs going forward than we have seen in the past, with zero and even negative credit costs over the last 3 to 4 years.
Okay, so essentially you're negative with regards to this industry as a whole. Are there highlights, though?
If there's a highlight, it's probably in the domestic lending. Some interesting statistics out of the Japanese Bankers Association released in the last few days showed that lending in April domestically, and it was actually up year on year around about 4%. Certainly the major banks have seen growth of around 3.6 to 3.9% in their lending. Some of the regional banks are also benefiting as well. What's driving that loan growth in April has been simply major corporations drawing down credit lines in anticipation of having problems with their own supply situation because of the coronavirus pandemic. And the Japanese banks, with more cash than they know what to do with, have been very keen to lend.
Yeah, I mean, we can have a look at some of those, which, you know, the banks which perhaps you have highlighted as being the best performers. I'm looking at the likes of MUFG, also looking here at Shinsei Bank, and on top of that, SMFG. Now, I've been looking at the return on equity, which is quite often seen as a good measure of a bank's profitability, and all of them seem to have seen a decline. Looking at, let's say, MUFG, it was 8% return on equity in 2014. It's now down to about 5%. SMFG, 12.2% in 2014, now down to, what, 6% or thereabouts. What is that telling you?
Well, that tells me that they're under a great deal of pressure. They haven't been raising equity recently. They're happy to continue to see their risk assets expand. And because of the pressure, downward pressure, on net interest margins at home, they have to work a lot harder to try and keep interest income up, and that inevitably means that they're going to see declines in earnings overall, declines in net profit, and some pretty poor numbers for return on equity. But I have to say that Japanese banks, for years and years, have shown remarkably poor ROE and return on asset ratios across the board.
Brian, talk to us about provisions, because Singapore banks saw the provisions rise 80%. When it comes to Japanese banks, what can be expected?
For the major banks, you have, say, Mizuho, which is running at about 5 basis points in credit costs, to SMFG, which is running at about 15 so far this year. But if we see a move towards more forward-looking provisioning, we should expect to see that probably double. So for SMFG, at 15 basis points, I would think they would go to about 25 in this current fiscal year. And for Mizuho, for 5 basis points, that's extraordinarily low. I would expect to see that probably go to at least 10, possibly 15 in this fiscal year.
You talk about credit costs. Credit costs will weigh on bank earnings going forward. How much clarity do we have?
Well, from the results that have come in so far, we have seen that the biggest impact on earnings has been the effect of market valuations rather than credit costs. Credit costs going forward is something that the banks have yet to start to deal with properly, and I believe that's the reason why we should expect earnings overall, bottom line earnings that is, to be down 20-25% across the board for this coming fiscal year.
You know, unlike UK banks, Japanese banks are under no compulsion to refrain from giving out dividends. Are you expecting any?
I expect all of the major banks to maintain their dividends this year. We have seen some of the smaller banks cut their dividends a bit, but nobody has actually foregone their dividends as of March 31st this year that wasn't already known about. So we're not expecting any nasty surprises in terms of dividend payments, dividend cuts, or dividend suspensions, certainly not out of the major banks.
Brian, you've got the big three there in Japan, but you've got so many smaller banks. Is there a sense that they need to consolidate? Is Japan overbanked in any sense?
The problem is not so much the number of banks. The problem is the amount of cash they've got that isn't being lent out. The banks are awash in cash. If you took the 102 regional and secondary regional banks and mashed them all together into two banks, you'd still have the same problem. They've got nobody to lend to and far too much cash. So it's not a capital problem. It's not a credit problem. It is simply a question of a liquidity problem in that they have hyper-liquidity, and that's not going away anytime soon. Yes, over the next few years, we should expect more banks to be looking to merge, to consolidate. The reason that they do that is for survival. It's not because they want to improve shareholder returns at all. That's not on their list of things to do. But with in an environment where we have been in virtual deflation since 1998, we've been near zero interest rates since 2003, and at negative interest rates since 2016, that inevitably has a very big impact, negative impact, on banks' profitability, and for some banks, they're starting to run out of road.
Brian, that's one of the smartest things I've heard for a long time, actually. It sort of reflects what's going on, as you mentioned, deflation, and then the consumer's not willing to spend, the banks aren't willing to lend. That causes a perfect storm, doesn't it?
It could do. What I will be looking for is, especially amongst the major banks, is to see revised action plans, cutting staff, closing or merging branches, cutting back on the number of ATMs they have in use. The focus should be going forward on cost reduction. If they can't get people to lend, so to improve their interest income, they must increase their fee business, and they must cut back on costs, and staff and facilities are the best way to start. But it's not an easy task.